Now, before we get into all of the housing data, we just wanted to reiterate some of the impacts on the Consumer Confidence Board confidence numbers. So when you look at, again, it's still elevated versus where we were previously, but I should, and by previously, I mean during COVID. But now when you start looking at the prior month and the present situation, so the present situation, it was expected at 149.6, came in at 152.9, but the expectations, the one that we look at going forward, is 77.5 versus the estimate of 79. And if you think about buying a home, that is a future, okay, where are things going to go in the future? Is the house going to go up in price? Is it going to appreciate? What is your time frame? If you're buying a home right now and you're looking to hold it for the next 20 years, and there's some ability to do some extensions or to upgrade, you're most likely going to be fine. But someone that is looking to live somewhere for 3, 5, 8 years, maybe a starter home or a home that is that you want to live in for a bit and then try to get something bigger as your family expands, it's really hard to say, I'm going to buy now and 3 years' time make my money back and then some. And that's where you're getting some of this pause and some of these uncertainties. And then because homes are so emotional, you have, as prices come down or as buyers go away, people who are and the sellers are like, well, that, the guy down the street just sold his home for $50,000 more than what I just sold my home for, and my house is nicer, so I'm not taking down my price. And that's where you start to get some of this stickiness where the data weakens, but home prices don't do anything. If anything, they go up a little bit, maybe they come down a bit, but they don't really start to weaken until you get those that are kind of forced to sell or have to move because of work or because of downsizing. And then you have, okay, well, I just need to get out, so I'll take a lower price. And then at the same time, if they're also going to buy something as they downsize or what have you, if that downsized home goes down, then they're like, all right, well, I'm going to spend $100,000 less on this house that I'm buying, so I'll accept $75,000 less from what I'm offering my house for. So again, that's where the expectations matters the most. So this is just putting kind of all of that together. When you start looking at mortgage rates, which are in blue, which have obviously gone back up, this is a little elevated. It's come down a bit to a 5.1, and now today it's back up to about 5.2. So, but then when you look at buying condition for homes, which is orange, which is University of Michigan, it's the worst ever or the lowest it's been since the 1970s. And then when you look at existing green, so existing home sales are down and approaching what is a concerning level, but the purple home sales is struggling and is actually approaching a recessionary trigger. And not to say that it's going to pull us into a recession, but it's reaching levels that we normally don't get to unless we're heading into a recession or are in a recession. And that's going to be something to look at. Is it a leading indicator? Is it a present day indicator? And that's where I believe it to be a leading indicator. I don't think we're in a recession right now in the U.S. Same can be said about Europe, but it's something where I do think it's much closer than people expect, and that's where we start talking about Q3 and Q4, not even in 2023, but really what we can start to see, because Q1 was negative. Some of that was just financial, math-based, but the real pressure we think really picks up on that Q2, Q3 event. So then you look at April construction, it was expected to be at 0.5%, came in at 0.2. Again, some of that slowdown in construction is being led by new construction. You still have a huge, very deep laundry list of things that you're waiting for, things that are currently under construction, so you're not looking to add anything to that at this point. It's the softest month-over-month print since July of 2021. Private construction still at up 0.5%. Private residential 0.9%. Home improvement 1.5%. Non-residential and public continues to diminish, but private residential home improvement still up. Still, that's where you're seeing that move. But there's a huge backlog of things under construction, so we expect that to stay the case, remain the case. It's just when you look at the leading indicators in terms of permits and new construction, that is where you're starting to see that slowdown, because again, you're just not seeing the same type of demand. Now, housing continues, again, looking at weakness, buying conditions for how homes, good time to buy a home. Case-Shiller home price, and then if you look at the inverted mortgage rates, it just shows you the trend. As rates go up the way they have and the pace in which they've had, typically you have those home prices again fall just because it's more expensive and people need to be able to afford it. And then every recession has been preceded by weaker housing, again, leading, showing this more of a leading indicator versus kind of a present day indicator. And there's typically leading, present, and lagging. And this is the one that, again, we've been talking about as a leading indicator of some of the pressure points because people have borrowed against their homes. Equity lines. Well, equity line's kind of expensive and I don't really need anything different. I'm just going to pay it off. Or I've used this money. What am I going to do? And then as the concern rises because as as home prices fall, the equity value falls. And then that puts more pressure, something similar to what we saw in '08. And then I still love this chart, the purchase only house price index, and then the average hourly earnings of production and non-supervisory employees. So, you have average hourly earnings coming up just a bit, but then you have this huge explosion in home prices. And again, you can have that divergence. I'm not saying you can't, but we've never had the rate of change that we currently have. And again, it's just, we do expect to see this come back down, especially as quantitative tightening accelerates. Mortgage rates versus house price index, looking at it a bit differently. Again, taking the chart earlier and looking at it because you have wages not keeping pace. You have mortgage rates going up, which again, all of this is just showing that pricing is going to move in one direction. And then the Redfin Home Buyer Demand Index came down to negative 12% year over year. Still elevated, obviously, when you look at from 2020, but you're starting to see that slowdown, and the trend is moving in the opposite direction. Nearly 1 in 5, or 19.1%, home sellers dropped their price during the 4-week period ending May 22nd. Highest level since October 2019. And then firms' home buyer demand index down 12% year on year. So again, you're starting to see pricing come down a bit. Taking it down $1 is going to register. So you have to put this in perspective in terms of where is it slowing? Is it everywhere? Is it just certain locations? Which is why it's important to look at this. So new homes, U.S. new home sales, number of homes sold each month, seasonally adjusted. So you can see a big drop in the South, the West, and obviously the Midwest and the Northeast never saw a huge spike. So there's really, everything's been fairly stable. It's the South that saw the biggest increase, and now you're seeing the biggest decline. And that's something where there's two pieces to that. There's still limited supply because a lot of it's under construction. So as that finishes, you'll have some of the homes being sold. But then there's also, well, I can't move there anymore, or my plans have changed because I just can't afford it. So again, these are some of the key pieces, but let's say the next 4 months, I think will be telling, especially for the South, given where it has fallen. And as that new supply comes on, do we get that adjusting? Do people look to buy again in the winter months for people that want to be their, snowbirds? And that's, I think, going to be a key component. As we've seen home prices continue to surge higher. And again, even though they're going up, it's just a matter of the home price index based on Case-Shiller. So when you look at just the value of the homes and record home prices in March, because remember, it's a matter of what month are we talking about. So in the Redfin data, we're talking about May. So in the Arbor data, we're talking about May. In the Case-Shiller, we're talking about March. So it's going to, that's something where we see this coming down, but still remaining elevated. Not like we're seeing this huge contraction, but this is going to be a key one to watch as the mortgage purchase index edged lower and is back to the lowest since the summer of 2020 of people just not getting mortgages, not wanting mortgages. And it's obviously because of where we are on those rates. University of Michigan buying conditions for a house. You can see it's the lowest since the early 1980s, just to give you an idea of just how bad it is. And then using this in terms of pending home sales index and where we are on that level, the annual change in pending home sales at negative 11.5% is hovering near recessionary territories, which again is more of that leading indicator that we've been talking about. Now, when you look at U.S. durable new orders and how the consumer is responding and how this is impacting some of those leading indicators, U.S. durable goods new orders ex transportation was expected at 0.6, came in at 0.3. Orders non-defense ex-aircraft expected at 0.5, came in at 0.3. Again, some of these slowdowns, some of the durable goods, as we've been talking about, the goods side, we do think has an accelerating slowdown as services pick up, but not at the same pace. All the while, when you look at what is happening in the market, you have, right at this point, you can see that the back to work, the office occupancy is still around about 2/5 of its pre-pandemic average. And it's actually starting to come down, not because of anything COVID related, but it's the summer. So people are going to want to work from home a bit more, spend more time outside. And that's where we just think that the shifts are real in terms of hybrid, remote working, which again is going to keep us fairly depressed. Then when you look at Chicago, PMI bounced higher in May, likely in part to autos, because you did have an increase in auto production, which again, with obviously Detroit being the key piece, which Chicago Fed picks up. So that was a positive. So to 60.3 versus the estimate of 55. New orders, prices paid, inventories, and production all rose at a faster pace. Prices paid, rising at a faster pace, but supplier deliveries rose, but at a slower pace, and employment is still contracting just at a slower pace. So again, fairly mixed, but really leans more bullish given the truck data, the car data. Now, retail inventory to sales ratio, retail inventory to sales ratios are above pre-COVID levels, which just means that we expect to see retailers starting to increase their discounts again, because before inventories were tight, they didn't have to offer discounts, but how much is that going to eat into margin? So when you start looking at margin contraction, this is typically where it starts to accelerate because the inventories are higher than what they should be. And that's where you'll start to see those inventories, them trying to manage it and again, pull that down. So when you look at Kansas City Fed Manufacturing Index, the survey was for 15, came in at 23. Kansas City manufacturing new orders picked up slightly. Again, these are two decent, and especially the new orders being a fairly good leading indicator. But then on the other side, when you look at the Dallas Fed, fell in May to negative 7.3 versus the estimate of 1.5. New orders, CapEx, hours worked, delivery times, and wages all ticked lower, but still expanding. And again, that's where we're getting that slowdown. But it's Q2 is going to have growth. We're not going into this nosedive, something I think that the Europe is seeing, but the outlook sank further into negative territory, and employment is still holding up despite ticking down. So you're still seeing some of those pressure points that we've been talking about, with the Dallas Fed Manufacturing Index as coming in at negative 7.3, and then the company outlook coming in negative, which is where we see some of these pressure points. And it's still mixed. You still have some areas growing, but you have some areas shrinking. And then the leading indicators for some of them are getting worse, but again, still elevated. It's still positive, which is why we see Q2 doing what it's going to do, new orders being one of them in Dallas. It came down again, but positive. So it's still trending in the wrong direction, but still elevated, while the growth rate of orders went negative, which means that we should see new orders go negative in June. And again, that's why we think that Q3 is going to be a bigger problem than what the market is expecting, while Q2 will print something positive in terms of growth. So that's what we have for you for the U.S. In the next segment, we're going to go deeper into Europe and the cascading issues that we see on the in the EU and just Europe in general.